SpaceX just raised $75 billion in the largest IPO in the history of finance. The pitch was simple and thrilling: rockets, satellites, and artificial intelligence. The future sold by the slice. But follow the very first dollars out of that raise, and they don't go anywhere near a rocket. The first $20 billion of the money SpaceX raised is already committed to paying off debt, specifically the high-interest debt left over from Elon Musk's purchase of Twitter years ago and entirely unrelated to space. Before a single dollar reaches a launch pad or a satellite or an AI chip, 20 billion of it walks out the door to clean up an old deal. And here's the strange part. That fact is in the filing. It's disclosed. It's just not in the section where you'd expect to find it. The document that tells investors what the money is for doesn't mention it. You have to go dig it out of a footnote about debt, several hundred pages away, and connect it yourself. That turns out to be the pattern for this entire IPO. Every number is in there somewhere. Every commitment is technically disclosed. What's missing is the addition. Nobody adds them up, and when you do, the numbers describe a company in a very different position than the one investors thought they were buying. This is the arithmetic SpaceX disclosed, but never performed. To see the gap, you have to understand the difference between disclosure and coherence. A company going public files a document called an S1, a prospectus that can run hundreds of pages. By law, it has to disclose the material facts about the business: the debts, the obligations, the risks, the commitments. But the law requires that each fact be present. It does not require that they be added together for you. The debts live in one section. The future commitments live in another. The use of the money lives in a third. Each is accurate, each is complete, and each sits far enough from the others that almost nobody assembles the full picture. SpaceX's S1 is roughly 277 pages. Inside, it is a company that genuinely dominates space launch, a satellite business that genuinely makes money, and an AI division attached through a recent acquisition. That's the story on the surface, and parts of it are real. Starlink, the satellite internet business, is profitable. The rockets are the best in the world. But underneath that surface is a set of financial obligations that, taken individually, each look survivable, and taken together, describe something else entirely. The $75 billion raise sounds enormous. The question this script asks is the one the filing never does. Enormous compared to what? Because once you start adding up what SpaceX has actually committed to spend and repay, 75 billion stops looking like a war chest and starts looking like a down payment. Start adding. Begin with that first 20 billion. In March of 2026, SpaceX took out a $20 billion bridge loan to retire about $17.5 billion of old, high-interest debt. Debt-carrying rates as high as 12.5%, much of it left over from the Twitter acquisition. To get out of that expensive debt early, SpaceX paid more than $1 billion in prepayment penalties and absorbed another $1.5 billion in accounting losses. And that bridge loan has to be repaid within 6 months of the IPO. So the first call on the new money is not space. It's the bridge. 20 billion spoken for before anything else. Now add the future commitments. Scattered across the filing, in different sections never totaled, are SpaceX's contractual obligations coming due by 2030. An independent analysis that did the work of adding them up arrived at a figure of roughly $235 billion. $235 billion in commitments against a raise of 75. The money coming in covers less than a third of what's already promised to go out. And the money is leaving faster than it's arriving. In the first quarter of 2026, SpaceX's free cash flow was running at a deficit that annualizes to roughly negative $36 billion a year. The company holds around $16 billion in cash and another $8 billion in marketable securities. Set the burn rate against the cash on hand, and the timeline gets short very quickly. This is the context the $75 billion headline is sitting on top of. The raise isn't the story. What the raise has to cover is the story. Then there's the debt itself. And here, the gap between disclosed and aggregated becomes almost literal. On the cover page summary of its finances, SpaceX shows debt of about $29 billion. That's the number a casual reader takes away. But add up the actual obligations described throughout the filing, and the real figure is closer to $42 billion. The difference isn't hidden in the sense of being concealed. It's spread out. There's the $20 billion bridge loan. There are two separate term loans tied to the old X business, totaling nearly $13 billion, maturing in 2029 at effective rates around 10 to 12%. And there's another $9 billion in what the filing calls other financings, equipment leases structured in a way that accounting rules require to be treated as debt, even though they aren't labeled that way on the cover. That last category deserves a moment because it shows how the structure works. Those leases come from an investment firm whose chief executive sits on SpaceX's own board. Money the company owes to an entity connected to its own boardroom, classified under a heading most readers will never reach. It's disclosed, it's related party, and it's nowhere near the $29 billion headline figure. The X-related debt alone generates well over $1 billion in interest every year. Interest that has to be paid out of a company already burning cash. So the debt isn't $29 billion, it's $42. The gap is $13 billion, and it exists entirely in the space between what the cover page says and what the full document, properly added up, actually contains. And then there's the strangest item of all, a side deal that quietly forces SpaceX to spend money it may not want to spend. About a month before the IPO, SpaceX signed an option agreement to acquire an AI coding startup called Cursor for $60 billion, payable in SpaceX stock. An option, not an obligation. SpaceX can choose whether to go through with it in a 30-day window that opens shortly after the IPO. On its face, that's just a possible acquisition. Companies sign those all the time. But read the terms. If SpaceX declines the deal, it owes a termination fee, $1.5 billion in cash, plus another $8.5 billion in deferred services fees. $10 billion in cash simply for walking away. Now weigh the two choices against the balance sheet. Option 1, spend $60 billion in stock to buy the company. Option 2, pay $10 billion in cash to not buy it. But SpaceX is burning cash and holds only about $16 billion of it. A $10 billion cash penalty is not something this balance sheet can comfortably absorb. The $60 billion stock deal, by contrast, spends the one currency the IPO just manufactured in abundance: SpaceX shares. So the structure quietly removes the choice. The option is designed so that declining is more painful than agreeing, which means SpaceX is effectively steered into deploying $10 billion worth of its freshly minted stock before the public market has had any real time to establish what that stock is actually worth. The deal commits the new currency before the currency has been tested. Stack it up against the same pattern from the rest of the filing. The Terafab chip factory is described to a Texas county as a project worth between $55 and $119 billion. A filing made just 14 days before the S1. Yet the S1 itself states the company has no contractual obligation to build it. Same project, 2 documents, 2 weeks apart, 2 different stories, depending on which audience is reading and what each disclosure requires. The pattern is everywhere. Each number defensible in isolation, the set never reconciled. So let's perform the addition the filing declines to. The raise, $75 billion, of which maybe 30 to 50 is actually usable after fees and the bridge repayment. Against that, 20 billion committed immediately to old debt. 235 billion in commitments due by 2030. 42 billion in real debt, not 29. A cash burn that annualizes to negative 36 billion a year. And a side deal engineered to push 10 billion in stock out the door before the market can price it. Every one of those numbers is in the document. Not one of them is false. The bridge loan is disclosed. The commitments are disclosed, section by section. The full debt is there if you total the line items. The cursor penalty is in the agreement. The Terafab figures are in a county filing anyone can pull. SpaceX did not lie. That's precisely what makes this worth understanding, because the misleading impression isn't built from a single false statement. It's built from true statements, placed far enough apart that the reader never assembles them into the picture they collectively form. That picture is a company that raised an historic amount of money and is, even so, committed to spending several times that amount against a balance sheet bleeding cash, while structurally nudged into deploying its brand new stock before anyone knows what it's worth. The 75 billion headline says strength. The arithmetic says something far more precarious. And the only thing standing between those two readings is whether you did the addition yourself. This is the difference between disclosure and honesty. Disclosure is putting every fact in the document. Honesty is making sure the facts add up to a true impression. SpaceX delivered the first. The second was left deliberately as an exercise for the reader, and the reader mostly doesn't do it. There's a fair objection to all of this, and it deserves stating. Big, ambitious companies routinely commit to spending more than they currently have. That's what growth investment is. Amazon did it for years. Tesla did it. The commitments due by 2030 are not all due at once, and a company growing fast can fund tomorrow's obligations with tomorrow's revenue. If SpaceX's businesses scale the way the bulls believe, the arithmetic that looks alarming today resolves itself. That's a real possibility, and it's the case the optimists are making. But notice what that case quietly depends on. It depends on the future arriving on schedule to cover commitments the present can't. It depends on the reader trusting that the pieces, though never added up in front of them, were arranged in good faith. And it depends on not looking too closely at the fact that the first $20 billion of the largest raise in history went to clean up a social media acquisition before it touched the business investors thought they were funding. The numbers in the SpaceX filing are all true. That was never the question. The question is what they sum to. And the filing is built page by page, section by section, to make sure you never quite find out. 277 pages, every figure in its place. And the one calculation that would tell you what you're actually buying is the one calculation nobody is asked to perform. So before the rocket, before the trillion-dollar dream, before the AI that's supposed to justify all of it, there's just arithmetic. SpaceX disclosed every number. It simply never added them up. Now you have. And the sum looks nothing like the headline.